You're listening to Indications by the Conference Board.
Welcome to the Conference Board's Indications podcast. Indications is a public podcast featuring our global roster of thought leaders. Topics range from economic growth and competitiveness to human capital, governance, sustainability, and beyond. Each episode is a serious conversation grounded in data and insights that will keep you ahead of the curve in a turbulent world. I'm here with my colleague Lynn Franco, Senior Director of Economic Indicators and Surveys at the Conference Board. Welcome, Lynn. It's always great to speak with you.
Great to be back, Dana.
So let's discuss the most recent consumer confidence survey. So consumer confidence dipped in April, following a slight uptick in March. What's going on?
I think it's rather good news that we're holding steady considering this high inflationary environment and the war in Ukraine, which is casting some uncertainty. So, when we dive a little deeper into the numbers, we see that in terms of the present situation, there was a little bit of softening, but overall, the level of the present situation index at 152.6 remains historically strong and really is indicative of an economy that is continuing to expand. The expectations index, which had dipped last month, actually ticked up a little bit. So while consumers remain relatively cautious in their outlook, it could have turned a little bit worse here. We could have had a little bit of a downturn given the current situation. But overall, I think pretty good news.
So would you say that the data are telling us that consumers do or don't expect a recession at some point this year?
Consumers don't expect a recession. In fact, we've got this very strong reading on the present situation, which, if anything, says maybe growth softened a little bit in Q2, and that's right in line with our forecast, where we see some softening in Q2 with a relatively somewhat stronger growth in the second half of the year. The expectations index as well, while it's below that 80 mark, it ticked up. So this is probably more of a shock that we experienced in March. And given the war in Ukraine, we think that was really the cause for the downturn as opposed to a signal. So I think right now consumers are a little bit cautious about the outlook, but they're certainly not flashing any recession signals.
Well, that's a load off. That's really great news. So, why don't you delve a little bit more deeply? What were the key drivers of the present situation index, as well as the key drivers of the expectations index?
Well, we had a little mixed news in how consumers rate current business conditions. While the proportion that said conditions were good went up, we also had a slight uptick in those that said they were bad, but still a very favorable reading. Employment also eased a little bit. So the percent of consumers telling us that jobs are plentiful declined, as did the number who were telling us that jobs are hard to get rose. However, these are, especially the jobs plentiful, was coming off a historical high in March. So this level is relatively strong and still indicates that we have a strong labor market with, potential for more growth in the coming months. When we take a look at sort of the expectations, we see a little bit of softening in the outlook for business conditions, a little bit of softening in the outlook for employment, a little bit more mixed towards the positive news in terms of income expectations. So that should help support spending, although we do expect spending to soften over the next few quarters.
Well, I'd like to talk a little bit about buying plans. So, first, let's talk about durables. What are consumers saying about buying big ticket items like automobiles and appliances and sailboats, those kinds of things?
Well, we did see a slight uptick in the durables. So a few more consumers said that they intended to purchase an automobile or major appliances. We had a slight uptick in home purchase intentions, but we're not at levels that we saw earlier this year. And part of that is not only, supply chain shortages, but also price increases, but also interest rate hikes. And I think we're going to begin to see that in especially housing intentions, right? We've seen it in some of the other home data that's come out over the recent weeks, where we can already see the impact of interest rates on mortgages, which are now at least a 30-year mortgages, above 5%. So I think we're going to continue to see a little softening in some of these big ticket items.
So, okay, so a little bit of good news this month, but still some evidence that consumers are feeling the pressure of higher prices and certainly rising interest rates. Certainly, when you think about home purchases, what about we've talked, ad nauseum almost about consumers starting to downshift a little bit and buying durable goods and picking up in consumption of services. Now the pandemic, even though I mean the disease is still out there, but people have kind of moved on from the pandemic. What are the vacation plans telling us about whether or not we're starting to see a notable pickup in demand for services?
Well, we did see a bit of a decline actually in vacation intentions. And that could be sort of a twofold. It could be A, that we've seen price increases in the cost of, airline tickets, for instance, especially being driven up by increase in oil prices. Also, we've seen some, labor shortages, right? Not enough pilots to fly planes. So the airlines are a little stretched here. And there still might be some lingering fears around the COVID environment. So a combination of factors, probably, but still. We're better off than we were last April. So while, vacation intentions have softened, they're not as weak as they were a year ago.
That certainly is great news, and certainly for the outlook. Now, in our forecast, we're projecting somewhat slower, well, I should say notably slower consumer spending this year relative to last year. I mean, again, last year a lot of the spending was bolstered by fiscal stimulus checks and child tax credits um, and those kinds of injections into income aren't necessarily present now, but inflation's a big deal, and you mentioned that consumers are really concerned about it. What are our inflation expectations gauges telling us now? I remember, I think in the last reading we'd reached an all-time high. What In March? What happened in April?
We had a little bit of a pullback in April from a historical high. However, overall, it still remains quite elevated. So, price increases and inflation overall are still a concern to consumers. And on top of that, you add in interest rate hikes. And what we're seeing is that these interest rate hikes that are anticipated are causing consumers, at least a significant proportion of consumers, to postpone any big ticket items. So I think for the time being, the combination of these two may keep some consumers on the sidelines and therefore contribute to the softening that we anticipate in consumer spending.
Did you notice any regional or income based differences in the data, or is it just kinda too volatile for us to really tell?
Well, I think, one interesting aspect that we always sort of keep an eye on is the tale of two consumers. So we see the less affluent consumers where confidence is still sort of below the national average. Probably more due to the fact that these consumers tend to be more impacted by increasing food prices and gas prices, takes a bigger bite out of the budget, less discretionary spending. But we also saw a little bit of easing amongst the affluent consumers, and that's sort of taking the 3 month average view. And that could be due to the volatility that we're seeing in the financial markets, which is more likely to impact these consumers.
So, I mean, looking ahead, we've kind of depressed our listeners by talking about all the things that may cause consumer spending to be slower this year compared to last year: inflation, rising interest rates, concerns about the war in Ukraine. But what are some factors that can help continue to support consumer sentiment and thereby spending going forward?
The real key is going to be employment. So, what happens in the job market over the next several months is going to be critical. So far, we've seen that confidence has been able to withstand the pressures of the war in Ukraine, increasing prices, and at least one interest rate hike, with several more coming down the pike. So, I think as long as we continue to see employment remain relatively strong, it should help consumers and consumer confidence sort of offset some of these other negative factors that are at play.
And I think the strong linkages between our survey and the employment outlook is really unique and it's really great. And so we should definitely be looking at the labor market as kind of a signal of what consumer confidence may look like and then consequently spending. So my guess is that with all of this, that consumers are still going to go out there and buy things, maybe a little less because of higher prices and rising interest rates, and maybe some concerns about recession. But for the most part, our canaries in the coal mine are still singing, and it seems like consumers are still pretty optimistic despite all the headwinds that they're facing. Would you agree with that?
Absolutely. Consumers, I think, are willing and able to spend. So that should, continue to support spending, and totally agree that for now, the canary continues to sing.
Awesome. Thank you so much, Lynn, for such great insights. This has been Indications from the Conference Board. If you enjoyed this podcast, you may listen to additional The Conference Board offerings by going to our website, or you may find us wherever you listen to podcasts. Thanks again for listening.
This has been Indications from the Conference Board.